All right, welcome to the deep dive. Today, we're going deep on accounting.
Ooh, fun.
Yeah, I know, right? You know, when you hear accounting, you probably, like most people, just think spreadsheets and numbers.
Right.
But really, like, at its heart, accounting is about tracking stuff, right?
Yeah.
The movement of goods and services and money. Like, it's really it's the nervous system of any business.
Yeah, definitely.
But what's interesting is, like, while people have obviously been keeping track of their money for, like, as long as there's been money,
Forever.
yeah, the formal accounting standards we use today are actually relatively recent. Like, they mostly developed after the 1929 stock market crash.
Yeah, absolutely. I mean, before that crash, companies kind of like did whatever they wanted.
Really?
Yeah, it's a total free-for-all.
Yeah.
And then the crash kind of exposed like how bad that was
Oh, okay.
because investors didn't really know what was going on with their money.
Yeah.
There was no transparency. And like that's why after the crash, there was like this huge push to standardize like financial reporting.
Oh, okay. Makes sense. That's so interesting. So for our deep dive today, we've got Accounting All-in-One for Dummies as our guide. And the goal is really just to pull out those like core concepts and principles that you need to, grasp this field of accounting. We're going for like clarity and accessibility, cutting through all that jargon.
Absolutely.
Okay, let's jump in. So first, can we just start with the basics? What are the books? Like, what are we even talking about when we say the books?
Yeah, good question. The books refers to like a business's complete set of accounts.
Mm-hmm.
And all the journal entries that are related to those accounts.
Mm-hmm.
It's like a business's financial diary.
Okay.
So at the end of each fiscal year, businesses have to close the books.
Okay.
So because business is like continuous, right?
Right.
It doesn't stop on like December 31st. Right? But closing the books basically creates like a clean demarcation point for financial reporting and for tax purpose.
Okay, so like heading the safe point for the year.
Exactly. Okay.
Got it. And I know one of those like core concepts is debits and credits.
Yeah.
Which always sounds so scary. Can you just like break down the basic rules for us?
Yeah, so basically it's a double entry system, so every transaction is going to impact at least two accounts. And here's the rule. Assets and expenses increase with a debit and decrease with a credit. And conversely, liabilities, revenue, and equity increase with a credit and decrease with a debit.
Okay, so give me an example. Like, let's say Acme Widgets gets a small business loan. How would they record that using this whole debit and credit system?
Yeah, so they would debit cash, right, because they're getting money, and cash is an asset.
Okay.
And then they would credit notes payable because they now owe money, and that's a liability.
Okay.
So, like, every transaction has a debit and a credit.
Got it. Okay, so like, if a business buys more inventory, which is an asset, they would debit the inventory account.
Exactly. And if they pay for that inventory with cash, they would credit the cash account.
Okay.
It's all about keeping things in balance.
Yep.
Like the accounting equation, assets equals liabilities plus equity, has to always be true.
Okay, I see. So every dollar a business controls is either owed to someone else or it's the owner's stake.
Precisely.
Okay. Starting to see the balance here. So the source also mentions journals, specifically cash receipts journals and cash disbursements journals. Can you break down what those are?
Yeah, so those are special journals used for tracking specific types of cash transactions. A cash receipts journal tracks all the cash coming into the business, like from sales or customer payments. And the cash disbursements journal tracks cash going out, like paying bills, salaries, buying supplies.
Okay, so what kind of info is typically in these journals?
At the very least, it'll have the date of the transaction and the name of the account it affects. But you might also see extra columns for more details depending on the business and its system. Like a cash receipts journal might have separate columns for different revenue types.
Okay, so detailed records of cash coming in and going out. Got it.
Exactly.
So now we've got this like foundation of accurate record keeping, right?
Right.
But another big part of accounting is how businesses manage and value their assets. And for a lot of companies, one of the most important assets is their inventory.
Yeah, totally.
So let's dig into the different ways that inventory can be valued. But before we do, the source talks about what makes financial information actually useful.
Yes.
So it lays out these key characteristics. Can you walk us through those?
Sure. So the first one is understandability. So the information has to be presented in a way that someone with like a reasonable understanding of business can actually understand it.
Yeah, we don't want like financial hieroglyphics.
Exactly.
Okay.
Yeah.
So what's next?
Then you have relevance. So the information has to be useful for making decisions. It should help people form opinions about what happened in the past, predict future outcomes, and confirm or correct prior expectations.
Okay, so it's not just looking in the rearview mirror, it's about looking ahead too.
Exactly. And then there's reliability. So that means the information has to be verifiable. Like there should be evidence to back up the numbers. It has to be unbiased and materially correct. It should reflect what actually happened, not just what people wish would happen.
Okay, so reliability builds trust. What about comparability?
Yeah, so comparability means that people should be able to compare the financial information of different companies or of the same company over different time periods. So, for example, knowing what depreciation method a company uses can help you compare its profitability to a competitor.
Oh, that's interesting. Okay, so you need consistent reporting for those comparisons.
Exactly. And the last characteristic is consistency, which means that companies should use the same accounting methods for similar transactions over time.
Okay.
So if they change methods, they have to disclose that and explain why. And this helps people track trends more reliably.
Okay, so these characteristics kind of paint a picture of what good, trustworthy financial information looks like.
Yeah, sure.
So let's talk about where this information comes from. The source talks about these source documents. What are those?
So source documents are basically the original records of a transaction. Think like sales receipts, vendor invoices, purchase orders, things like that. They document like the terms of the deal between the business and the other party.
Okay, so these source documents are really the foundation of the whole accounting system.
Right.
And the source stresses how important it is to have like standardized procedures for handling these documents.
Yeah, because if your paperwork's a mess,
Yeah.
you're going to have errors in your accounting records.
Right.
And then that leads to like headaches when you're doing taxes or financial statements.
Headaches that nobody wants. Okay, so now that we have the accurate record keeping handled, let's switch gears and talk about inventory. The source talks about these different inventory evaluation methods. Can you break down what those are and why they're important?
Yeah, so inventory evaluation methods basically determine how you calculate the cost of goods sold and the value of the inventory you still have on hand. The cost of inventory can fluctuate, so businesses need a consistent way to account for what they've sold and what they still have.
Oh, okay.
So the source highlights three main methods: LIFO, FIFO, and weighted average.
Okay.
LIFO stands for last in, first out, so it assumes that the newest inventory items are sold first.
So like at a hardware store, they put the new hammers at the front, and those are the first ones to sell.
Exactly.
Okay, what about FIFO?
So FIFO stands for first in, first out, and it assumes the opposite. So the oldest inventory items are sold first. This often aligns with the actual flow of goods, especially for things that expire. Like think of a grocery store. They want to sell the older milk before it goes bad.
Right, right. So LIFO and FIFO are opposite assumptions.
Yeah.
What about weighted average?
So weighted average calculates an average cost for all the goods available for sale.
Yeah.
Every time you buy more inventory, you calculate a new average cost. And that's what's used to determine the cost of goods sold. This is useful when prices change a lot, and it's impractical to track the cost of each individual item.
Okay, that makes sense. And the source also mentions specific identification.
Yeah, so specific identification is used for really expensive, unique items, like where you can track the exact cost of each individual item. Think like a car dealership. They would track the cost of each specific car.
Oh, okay. Got it. And the source gives a formula for gross profit, sales minus cost of goods sold. So how do these different inventory methods affect that?
Well, because the cost of goods sold is based on which inventory costs are assigned to the sold items, the valuation method you choose can impact your gross profit,
Okay.
at least in the short term.
Well, that can make a big difference on a company's reported profits.
Absolutely. Like LIFO would generally lead to a higher cost of goods sold, so a lower gross profit. FIFO would show a lower cost of goods sold and a higher gross profit.
Wow. That's a big difference. But the source does make an important point that in the long run, when all the inventory is sold, the total cost and total profit end up being the same no matter which method you use.
Right. The difference is just in the timing of when you recognize those costs.
Okay, got it. So besides inventory, businesses also have those general supplies, right? Like pens and paper and stuff.
Yeah.
How are those typically handled in accounting?
So the source says those low-cost supplies that can't be directly traced to production are usually expensed right away. Like they're considered used up quickly.
Okay.
But for more expensive supplies, it might be better to track them in their own expense accounts just to keep a closer eye on those costs.
Yeah, that makes sense. For the control. All right, let's move on to employees. Crucial part of any business. The source mentions these tax advantage benefits. Like, are there certain benefits that don't have to be included in gross income?
Yeah, there are a few, up to certain limits. These are nice perks for employees, and they can save money for both the employee and the employer.
Hmm.
The source mentions things like education assistance, employee discounts, group term life insurance, occasional meals provided to employees, and qualifying moving expense reimbursements.
Okay, and what about Social Security and Medicare taxes?
Yeah, so the employer has to match the employee's contributions to both of those.
Okay,
When payroll is processed, the employer's share is set aside in a special account and will be paid to the government later.
got it. So it's not just the employee's contribution they need to worry about.
Right.
And I think the source mentions some quarterly filing requirement.
Yeah, so Federal Form 941 has to be filed every quarter and breaks down the employees' wages, tips, compensation, and all the taxes withheld.
Okay, lots of reporting. So what about the employee journal? Like, what kind of information is tracked there?
So the employee journal keeps track of each employee's pay, including taxable wages, Social Security and Medicare taxes withheld, federal and state income tax withholding, and their net pay. There might also be columns for non-taxable wages, like certain pre-tax benefits, the cost of benefits themselves, and then sick and vacation time.
Okay, so it's like a complete record of their compensation.
Exactly.
Okay, now let's talk about assets that a business owns and uses over time. The source talks about the depreciation of assets. Can you explain what depreciation is in accounting terms?
So depreciation is basically spreading the cost of a big asset, like equipment or a building, over its useful life.
Okay.
It's like acknowledging that these assets wear out or become obsolete over time. Now, depreciation is a non-cash expense,
Okay.
so no actual money is changing hands. But it impacts how much profit you report and how much tax you pay.
So it's not about the asset physically losing cash value, but it's about accounting for its usage over time.
Exactly.
Okay, and I know the IRS has rules about how depreciation is done.
Oh, yeah, absolutely. Because you could deduct depreciation on your taxes. The IRS has very specific rules about how to calculate it for different types of assets.
Got it. Keeping everything fair and consistent for tax purposes. So businesses often take on debt, right? What are some key things to understand about recording that debt?
Yeah, so for long-term debt, like loans, there's this thing called an amortization schedule, which breaks down each payment into how much is going towards interest and how much is going towards the principal.
Okay.
This helps you track how much of the loan you still owe. Banks usually provide these schedules, but businesses can also create their own.
Oh, that's helpful. And the source also talks about different types of debt.
Yeah, there's current liabilities, which are due within a year, like short-term loans,
Okay.
and long-term debt, which is due after more than a year.
Okay. So it's all about understanding like the timeline of those obligations.
Exactly.
Okay. So all of these individual transactions eventually come together. The source mentions the accounting cycle. Can you explain that in a nutshell?
Yeah, so the accounting cycle is basically a series of steps that businesses follow to record, classify, summarize, and report all their financial information.
Okay.
It's like a recurring process to keep the books accurate and up to date.
Got it. And most businesses do this on a monthly basis.
Yeah, they basically prove out their books each month by taking a snapshot of their finances.
Okay.
This helps them catch any mistakes early on.
Important for keeping things accurate. Now, I know almost every business deals with banks and credit cards these days. Are there any special considerations for those types of transactions?
Yeah, so bank fees are recorded as expenses, and interest earned is recorded as revenue. And for credit cards, those processing fees actually reduce the amount of cash you're getting from a sale.
Oh,
So
okay.
you have to adjust the cash receipt to reflect that.
Got it. Makes sense. And going back to inventory, how do businesses adjust those balances at the end of a period?
Yeah, there's a formula for that. Beginning inventory plus purchases minus sales equals ending inventory. Basically, you're tracking the flow of inventory.
Right.
Now, the total cost of the inventory stays the same, regardless of the valuation method.
Okay.
The difference is just in when you recognize those costs.
Okay, it's all coming together. Now, unfortunately, sometimes customers just don't pay their bills. What's the process for handling bad debt?
So when a business figures out a debt is unlikely to be collected, they have to write it off.
Okay.
Basically, they debit a bad debt expense account and credit the account's receivable account. The source stresses how important it is to assess the creditworthiness of new customers and have clear payment guidelines to minimize this issue.
Yeah, prevention is key. So let's zoom out a bit now. The source talks about the evolution of accounting standards. Sounds like it hasn't always been as regulated as it is today.
Oh yeah, definitely. While people have been tracking trades and keeping basic financial records forever, formal accounting standards are relatively new.
Hmm.
The Industrial Revolution really increased the need for more sophisticated accounting, but it wasn't until the 1929 crash that things really changed.
Okay, what happened after the crash?
So the American Institute of Accountants, which is now the AICPA, partnered with the New York Stock Exchange to establish the first 5 principles of accounting.
Wow, just 5.
Yeah, just 5. And now there are hundreds of principles covering every aspect of accounting.
Wow, that's incredible. And the source jokingly calls them the head nitpickers, but who are the organizations that actually set and enforce these standards?
So for accountants themselves, the AICPA has a code of professional conduct and an auditing standards board that sets audit standards. For public companies, there's the PCAOB and the SEC.
Okay.
The PCAOB actually uses the ASB's standards, but the SEC has to approve them.
Got it. So a layered system of oversight, especially for public companies. Now, how detailed are financial statements typically? Like how much info is actually provided about things like expenses?
Well, companies have to balance a few things. They want to be transparent, but they also don't want to reveal sensitive information.
Right.
Plus, nobody wants to read a novel-length income statement.
Ah,
So they often provide the key info on the main statements and then add more detail in the footnotes.
okay, a balance between information and conciseness.
Exactly.
Now, let's talk about specific expenses and liabilities. What about interest expense and accounts payable? How are those handled?
So interest expense comes from borrowing money. You debit the interest expense and credit either cash if you paid the interest or a payable account if you haven't paid it yet.
Okay,
And accounts payable is basically just money you owe to suppliers.
got it. What about notes receivable? Where do those go on the balance sheet?
So a note receivable is a written promise to get paid in the future.
Okay,
It's a current asset if you expect to get paid within a year,
okay,
and a long-term asset if it's longer than a year.
got it. And we've talked about inventory, but what are the different types of inventory?
The source mentions retail inventory, which is stuff sold in stores, and product inventory, which is for manufacturers.
Okay.
So that includes raw materials, work in process, and finished goods.
Okay, so different stages of getting goods ready for sale. And we've also talked a lot about liabilities. Can you give me like a basic definition of a liability?
Sure, it's basically an obligation to pay something in the future, usually money,
Okay,
like accounts payable, which is just money you owe to your vendors.
got it. The promise to pay later. All right. We can't talk about accounting without mentioning the famous accounting equation. Can you remind us what that is and why it's so important?
Absolutely. The accounting equation is assets equals liabilities plus equity.
Okay.
It shows that a company's assets, or what it owns, is financed by either debt or equity. The balance sheet is structured around this equation.
Right, it's the foundation. Now, how does owner's equity work for different business structures?
In a sole proprietorship, the equity account is usually called owner capital. It increases with contributions and net income and decreases with owner draws. Partnerships are a bit more complicated, but we won't get into that now.
Okay, so different structures, different equity rules. We also talked about fixed assets and depreciation. Where do those show up on the balance sheet?
So fixed assets, like buildings and equipment, are listed below current assets on the balance sheet.
Okay.
And accumulated depreciation, which is the total depreciation expense so far, is shown as a reduction from the value of the asset.
Okay, so it shows the net value of the asset.
Exactly.
Now, how are assets actually valued on the balance sheet?
Typically, they're valued at their historical cost, which is their original price. But there can be some exceptions, like if an asset's value drops below its cost, you might have to write it down because of impairment. But increases in market value aren't usually recorded unless the asset is held for sale.
Okay, so a conservative approach. Now, the balance sheet is just one financial statement. What about the statement of cash flows? What does that tell us?
So the statement of cash flows shows you how cash moved in and out of the company over a specific period.
Okay.
It helps answer questions like, can the company generate cash in the future? Can they pay their debts? And why does net income differ from actual cash transactions?
Got it. So it's all about the actual movement of cash, which is really important for a business to survive. And I think there are different ways to prepare this statement.
Yeah, there's the direct method and the indirect method.
Okay.
The direct method is preferred, but many companies use the indirect method. But no matter which method you use, the ending cash balance has to match the cash balance on the balance sheet.
Okay, a crucial check. Now, a term you often hear in finance is liquidity. What does that mean in accounting?
Liquidity is basically a company's ability to have enough cash on hand to meet its short-term obligations.
Okay.
It's about being able to pay your bills on time.
Got it. And what are the risks if you don't have good liquidity?
Well, you might damage your reputation with vendors and customers.
Right.
Vendors might not want to supply you with goods because they're worried about not getting paid.
Yeah.
And customers might shy away from you if they think you're having financial problems.
Yeah, definitely want to avoid that. So how can you get a better understanding of a company's financial health beyond just looking at one period?
So trend analysis is really important. You're basically comparing financial statements from one period to the next.
Okay.
This helps you smooth out any one-time events or impacts from changing accounting methods.
Okay, so it's about seeing the bigger picture.
Exactly.
The source also mentions horizontal and vertical analysis.
Yeah, so horizontal analysis compares the same accounts over time, and vertical analysis shows each account as a percentage of a base amount.
Okay.
These help you identify changes in relationships in the statements.
Got it. Now, investors often care about return on investment, or ROI. How do you calculate that?
One common way is to divide net income by average total assets.
Right.
This shows you how well the company is using its assets to generate profits.
Okay, a key profitability metric. Now, for bigger companies, you often hear about these corporate annual reports. What are those all about?
Yeah, so they include the financial statements and then a ton of notes that explain the numbers in more detail.
Okay.
The SEC has specific requirements for these notes, especially for public companies.
So the financial statements are just the start. The notes really flesh everything out.
Exactly.
And what's the purpose of these reports?
So the reports are meant to build trust and confidence with investors.
Okay.
They provide context for the numbers and help investors understand the business.
Okay.
Some companies even include the SEC Form 10-K info in these reports to avoid having separate documents.
Got it. So it's about communication and transparency. Now, what's the importance of equity capital for a business?
Equity capital is like the foundation of a business.
Okay.
Without it, you can't get credit from suppliers or borrow money from lenders.
Right.
It shows that the owners are committed, and that gives lenders confidence.
So it's that skin in the game that builds trust.
Exactly.
And what do investors expect to get in return for providing that equity capital?
They generally expect a share of the profits through either dividends or increases in the value of their shares. They might also want to be involved in managing the business, and they expect to share the proceeds if the business is sold.
Got it. Potential reward, but also risk. So how is the value of shares in a private business determined?
Yeah, that's a good question. So private companies don't have a stock price that fluctuates daily like public companies.
Right.
They usually don't worry about an exact value until they need to, like if someone wants to sell their shares or if the business is being sold.
Okay.
In those cases, they determine the value of the whole business and then divide that by the number of shares to get a per share value.
Okay, that makes sense. Now, the source mentioned some differences between partnerships and corporations, particularly regarding liability and taxes.
Yeah, so in a partnership, the profits and losses are passed through to the partners, so they avoid double taxation.
Okay.
But general partners have unlimited liability, which means they're personally responsible for the business's debts.
Oh.
Limited partners have limited liability. Corporations are a separate legal entity, and they can be double taxed. The corporation pays income tax, and then the shareholders pay tax on any dividends they receive.
Got it. Different structures, different rules. Now, many new businesses start with a business plan. What role does accounting information play in that?
Accounting information is really crucial for a business plan, especially for the financial projections.
Yeah. Okay.
You need to have accurate historical data or data from comparable businesses to make those projections. The executive summary, which gives an overview of the business, needs to talk about things like capital needs and potential return, and those are all based on financial information.
Okay, so the numbers really back up the plan. What are some of the first steps in creating a financial plan?
So you need to gather information, either historical data if you have it, or data from similar businesses if you're starting from scratch.
Okay.
The information has to be accurate, reliable, and up to date.
Yeah, garbage in, garbage out. So once a business is running, how do they use budgets and financial statements for ongoing management?
Budgets are essential for making sure you have enough cash to cover your expenses.
Right.
You might have a budgeted balance sheet, which is a projection of your assets, liabilities, and equity in the future,
Okay.
and a budgeted income statement, which projects your revenue and expenses.
Got it.
And then there's the cash budget, which is like a projected statement of cash flows.
Okay, so it's all about projecting and planning. Now, for businesses that handle unique projects like a contractor giving estimates for individual jobs, there's this thing called job costing. What is that?
Yeah, so job costing is a way to track the costs of each individual job.
Okay.
You have direct costs like materials and labor used specifically for that job.
Okay.
And then you have to allocate indirect costs like overhead.
Okay.
This helps you figure out if a job is profitable and set accurate prices for future jobs.
Got it. So it's about assigning costs to specific projects. Now, the source also talks about activity-based costing, or ABC. How is that different from regular cost allocation?
So traditional cost allocation often uses broad averages to spread those indirect costs.
Okay.
ADC is a more precise method that tries to figure out what activities are actually driving those costs.
Okay.
So instead of just spreading costs like peanut butter, you're really trying to track them to the specific activities that are using the resources.
Got it. A more granular approach. What about variance analysis? What's the point of that?
So with variance analysis, you set standards for things like materials, labor, and overhead costs.
Okay.
And then you compare those standards to what actually happens.
Okay.
Any differences are called variances. And you analyze those variances to figure out why you went over or under budget.
Okay, so it helps you understand where you might need to improve.
Exactly.
Now, the source talks about target costing, which sounds really interesting. How does that work?
So with target costing, you actually start by figuring out what price you can sell a product for.
Okay.
You look at customer expectations and competitor pricing.
Okay.
And then you work backwards to figure out how to design and produce the product at a cost that lets you hit your profit margin.
Wow, so you start with the market and work backwards.
Exactly.
Okay. Interesting approach. Now, we've talked a lot about profit margin, but how do you calculate it and why is it important?
So profit margin is basically profit divided by sales.
Okay.
It tells you what percentage of each sales dollar you're actually keeping as profit. A higher profit margin is obviously better.
Right. You want to keep as much of that revenue as possible. Now, we talked about liquidity earlier. Are there specific ratios that businesses use to assess their short-term financial health?
Yeah. So they look at current assets like cash, receivables, and inventory, which they expect to convert into cash soon.
Okay.
And they compare that to their current liabilities, which are due soon. They use different ratios, like the current ratio and the quick ratio, to see how easily they can cover those short-term obligations.
Got it. So tools to monitor that short-term cash flow, what are some key things to think about when managing debt for a business?
So the source warns against taking on too much debt, especially long-term debt.
Okay.
You have to make interest payments and eventually repay the principal, which can strain cash flow.
Right.
And lenders might put restrictions on your business. So the source suggests things like using future cash flow to fund investments, maintaining good credit rating, and considering equity financing as an alternative to debt.
Okay, so balancing debt and equity for more financial flexibility. Now, we've used the terms cost and expense a lot. Are those the same thing in accounting?
No, they actually have different meanings.
Oh, okay.
So the price you pay for an asset is a cost.
Okay.
But as you use that asset to generate revenue, that cost gradually becomes an expense.
Okay.
So the cost moves from the balance sheet to the income statement over time.
Got it. And what about things you buy to sell to customers?
Yeah, those are initially recorded as inventory, which is an asset.
Okay.
And they only become an expense or cost of goods sold when they're actually sold.
Okay, so cost is the initial outlay, and expense is recognizing that cost over time as the asset is used or the item is sold.
Exactly.
Which brings us to the matching principle. What's the idea behind that?
So the matching principle says that you should recognize expenses in the same period as the revenue they help generate.
Okay.
So